Okay, let's continue where it froze. We just spoke about identifying a need, the solution, and the unfair advantage. This is what time it works. And that's basically the opportunity recognition, okay? So we need a need, a solution, and an unfair advantage, a reason why we can do that versus someone else doing that. Okay? On the other side, we need to acquire technology rights. We might have something with our invention, but we might need additional software or additional hardware for that to complete it. So we need to acquire those. We need to acquire the right people. Our startup team might be great technologists, but do we have the right mix? Do we have a salesperson? Do we have a marketing person? Do we have a legal person? Do we have a psychologist to understand our customers? Okay? Actually, psychology is not so far away. We've Intel, for user needs, hired anthropologists to try to understand user need and user interaction. A couple of the big moves in the recent mobile area were not because of really great technologies, but because they addressed a user need, a user approach, okay? Touch screens and the like. They get addictive. So I was asked once at a keynote, what was the biggest technology movement that I saw in the last couple of years? I said, well, you know, you're driving down the highway with your navigation system, and then you try to pinch the map. You realize that you're addictive to a different technology already, okay? So those are usage models that you have to address. So the right people and money, okay? Those are the resources. So we're trying to follow an opportunity where we don't have all the resources under control. So the resources, technology rights, people, money. Usually the biggest one that came up here as well is money. Okay? Technology, people, and money. These are very interchanged. Major trends: large companies and universities commercialized by small companies. So a lot of the universities have technology transfer offices where technologies are coming out, as well as, and we'll get to that a little bit later, bigger companies also outsourcing, you could say, bringing technologies outside of the company that are not strategic for their mainstream products. We'll talk about that in open innovation. New structures for pooling risk-tolerant investors. In the dot-com era, it was usually big VCs or relatively rich single angels that were investing. And they learned out of that as well. They had big losses in that time period. And so they're pooling. So you'll find that there are angel groups that will invest. And they will spread the risk by spreading the load of the investment so that they don't get hit as hard as they did in the dot-com era. Mobile technology, mobile people, people that will move around, mobile money, money that comes from different areas, like these angel groups that are spreading the risk. What other one can you think of? Very relatively recent, last 2 years? Starts with crowdsourcing. Also very new type approach to get your new venture funded. Okay, so there are movements there. Okay, mobile technology. How do you get to this technology? You have certain ideas yourself, but how do you get to those people? Okay. In some cases, you can hire the right people. You can hire people that were working at companies where technologies like that were available. And they have some things in their minds, in their background that can help you. They can't take an intellect, they can't take a patent, they can't take some of that technology directly, but you cannot hinder someone from leaving a company with what they know. So you find people like that. Or formally through licensing, you go and get a license from a company. The professional entrepreneurial management team, mobile people. This is something that has come up also in the last couple of years, that you as a team recognize you need a certain skill, and you can find those skills temporarily from a VC or other companies that can give you a mentor, a board advisor, a sales specialist for a short period of time. Okay, so you can basically enhance and complete your team without necessarily having to hire them. So not a permanent head. And typically, people like that want a piece of equity, so they would do that for a piece of your company. Acceptance of the risk of failure. We'll talk about failure in a second. New forms of private equity. Multinational corporations are becoming more active. Intel was very active. Intel Capital is the largest corporate VC with some $12 billion invested in a portfolio of over 1,000 companies. They are looking at technologies and new companies for certain reasons. I'll speak about that more in the open innovation area, because very strategically some of these big companies, I'm sure Samsung and Microsoft have the same, you'll probably be hearing some from them, a strategy of trying to make sure that new technologies make it. Sophistication of the angel communities I just spoke of in the money scenario. So what is the professional entrepreneur is there? So personal entrepreneurship styles. We said entrepreneurship is a team sport. Okay? So you're going to find different styles, different capabilities within your team that as a whole bring your entrepreneurial company up. But we have different types. So many can play, many can be part of the entrepreneurial team, but not necessarily the born entrepreneur. Okay? We see 3 modes: lead, follow, and execute. At the very beginning, all of these are done simultaneously. Okay, so the roles are not clear. So when you're starting, what are you, teams of 5 or 7, something like that? When you would start and you get a call from someone who wants to talk about your company, you're all all of a sudden the PR manager of the company, and you're talking about the company and telling them what it's about. If someone wants to buy, all of a sudden, if you're on the phone, you're the CEO or the sales manager. All of those roles, basically at the very beginning, are not really split. They're basically, everyone has every role. And we have three functions. One is to create, to manage, and to innovate. Okay? So if you start taking those and try to see how they interoperate, we get something like this, where a mixture, you have leaders, you have followers, and someone in between that's sometimes leading, sometimes following, is actually executing. High-performance entrepreneurial teams are self-organizing. I heard that you self-organized yesterday, how the teams you have are put together. Okay. They're flexible, self-disciplined. You all have a common goal, common priorities, common values, very much enabled by shared ownership. So typically the first startup companies, if there are 5 people, each own 20% of the company, independent of what they're actually doing right now. The same people may play different roles on different teams within the same company. That's what I meant earlier. Sometimes depending on who's calling and who's on the phone, you're playing a different role. And you might, as a small team, someone's off doing an evaluation and you get another request, so you're off doing a different role. Then if you take create and manage, in between you have the innovation. It requires a combination of creativity and management, which is brought by the team. And the creation requires the greatest technical competency. Management requires technical affinity, so you need to understand the technical side, what it brings to the customer, but not necessarily the knowledge. Different functions are best suited for different people, and these functions are typically rarely exchanged. So where we had before a very loose interaction, these functions are very rarely. Creation and management are very different roles. And now if we bring innovation and execution together, here we have entrepreneurship in between. So a split between that innovative side and the execution side. It's a blend of innovation and execution, requires collaboration and discipline. It's best performed by a team. The alignment of incentives directly and dramatically related to the outcome. So this is where you start to get incentives, sales incentives, executive bonus, etc., those type of things. And if we look at the 2x2 here, you have high creativity and innovation and management skills. Then you have the entrepreneur is in the upper right side. Okay? That's where we see the entrepreneur. So the entrepreneur, we said this is about, I'm supposed to stay behind here. It's about a big company that happens to be small. Remember we said that? Big company happens to be small. So what do I need to do? As an entrepreneur, I need to look out here, What does the company look like over here that I'm trying to build? My vision. And then I need to look backwards at what has to happen in each of these stages to get there. Okay, so it's not just walking forwards. Okay, I've got this idea. I've got a couple of people that think it's a good idea as well, so we'll start a team. And you know, it's not moving forwards without a long-term strategic plan. And the strategic plan is the vision of what that company would look like globally, big company. And then I go back and say, well, if I want to get there, I need to do this here, I need to do this here, I need to do this here, I need to do this here. And then I go very strategically, step by step, based on what I've put together as a plan. Okay? So the professional entrepreneur visions the future into the present. It says, okay, to get there, I need to do this. We have these 4 phases here. And we'll talk about what needs to be done in those 4 phases. One thing is also interesting and logical. In this area up to here is a zone of collaboration. Okay? So I might find another company that's, you know, very much aligned with me, and we're collaborating, exchanging information, talking, discussing, working together, trying to, you know, discuss these type of customers, those type of customers. And over here I have a zone of competition. Why is that? Why are these 2 different zones? Real easy answer, but why? Look at the curve. What's different?
Money starts going in. Money starts going in.
Money.
Profit.
Money. So here I'm making a loss. Who wants to copy a company that's making a loss? Not too many, right? And here I'm making money. That's when I'm, you know, in real competition, because anyone that's making money, they want to copy. So that's when you quit talking about details. So you can't collaborate in those things. You can make agreements and memorandums of understanding and all sorts of things, but it has to be very structured instead of loose. Entrepreneurship is a team sport. It's very good that we have these teams here. So the 4 phases of entrepreneurial venture, we just spoke about that. What do they look like? So we have those 4. And attributes that characterize each phase. So in this very first phase, that's this one here, okay? We're defining the business concept, we're gathering financial resources, we're trying to find people that will help fund it. We're assembling the startup team, you're putting a team together, you're recognizing who you're missing still within the team. You're identifying your first customers, at least what you think are your first customers. Analyzing the competition. Who am I competing against? Building the first prototype and getting your first customer. Okay? So, very early on here, just trying to spin up. We also call that the pure entrepreneurship area, because that's really where You're trying to bring all of this together. The second period is a strategic focus. So, what business aren't we in? Very early on, you can get very defocused by the many different opportunities you can take by going that way, that way, that way, that way, that way. And you very often want to do it all. And you need to define pretty early on, okay, nice to have, nice to have, nice to have. Let's focus on this, and that's it, at least for now. And then implementing the business you are in, those 2 or 3, getting that to work. And then knowing better than anyone else what people will pay. So how do you calculate that? Okay. Cost, profit, but also market. Okay. How many will they buy? How to distribute, how to service the customer. How to, if the product is in the market and there's issues with the product, how do I service them? The third area is system building. That's this one here. So you're already crossing over and you're starting to build your financial controls, a stable division of labor, so you're starting to have VPs of marketing, VPs of sales, et cetera, et cetera. So you're starting to get silos into the company with a clear division of responsibilities and activities. Reporting relationships, authorities, how much can you sign for? Can the salesperson do a deal over 20 million without asking the CEO? Okay. Responsibilities, you need to define those. Developing systems and internal control, formalizing the terms of a sale, warranty. Okay. You need to put a lot of formal legal processes in place to protect the company as well. Operational systems, your databases, etc. Production, thinking of outsourcing. Distribution, your distribution channels. Do I sell only via internet? Do I sell direct? Do I sell via Saturn, MediaMarkt, all of these different retailers? How do I split the margins between the different ones? If you have the margins wrong, you'll get bit by your interfaces there. Setting up your service, how long can I give a warranty? Also with the services, very often in a company early on, you're doing most of the R&D. And at some point in time, you're starting to get issues, problems with the products. How much of the people that are doing R&D can I take off and put into servicing the product? And then this last phase here, where it's really scaling, that's hiring the outsiders, okay? The ones that you really can't breed from within. Okay? If you need a real salesperson, you go and get a real salesperson from the outside. If you, in this case, want a professional CSO, you go and get a professional CEO. Okay? Do I go public? Do I do a IPO? Do I need more finances? Make acquisitions, okay? Buying other companies that complement my product, my strategy. adding the follow-on products. So when we focused on these two, okay, then the other 5 that we dropped, maybe there's now the chance to add 1 or 2 of those. Now that we're in the market, we're making money, we can reinvest some of that money to broaden our offering. And this one's really, really hard, shedding those who can't keep up. Does everybody understand what that means? I'll say it a little bit harder. Firing those in the team that can't keep up. So let's say you're a group of founders, 5, 3 of you have really excelled, brought the company up. 2 of you are kind of laid back and more watching than actively working. Okay, they're founders, but they're not bringing the company any further. So you might want to take a look and, define an exit strategy for those individuals. Very tough because very often these initial founding teams are good friends. Okay, but now we're talking business. Formalizing the culture. Company culture. You'll find that the big companies, ones that were small at one point in time, all have a culture. Why do they have a culture like that? Do you know what a culture is? Companies define certain values as being great for the company. At Intel, risk-taking was one. So individuals at a lower rank were inspired to actually not go up all of the hierarchy, but take decisions, take a risk, take a decision. Move forwards, because it helps the company to move quicker than it otherwise could if all of the decisions are made at a higher level. Okay. Cultures like that. The same size office. We had what we called cubicles. He was working with Intel in Ireland for a while, having cubicles. Cubicles is an office space of about 8 square foot. Okay, a couple of walls around you and barely a desk and a chair. All the way up to the CEO, the same size. Company culture. Okay, started in a garage type environment. Those things kind of stay and stick, but they have the advantage when you're hiring lots of people. It's very easy to tell them the do's and don'ts within this company. This is what we value, this is what we don't like, this is what we want to happen, this is what we don't want to happen. So you can hire lots of people quickly and spin them up to a certain level without having, to individually train each one. You can give them an employee handbook that says, this is a value that we like, this is, what we don't like. And then rationalizing the strategy. So here you've got the company up to a certain stage, you're making money. Where does our strategy go from here? Are we already the big company, or are we just an intermediate company? Do we still want to go further? Is this a product line that's going to stay for 10 years, or do we need a different one that will bridge and help us to move into the next 10, 20 years? Okay. So rethinking the company. So we were visioning the future into the present. Okay, and then went back to each of these phases, right? Yeah. The value of failure. I think you spoke a little bit about that yesterday, is that? Okay. Value of failure. Is that an oxymoron? Can failure be of value? I see some nodding, but no one answering.
Yes.
Yes, yeah, why?
Experience.
Experience, okay. What does that mean? We learn something. Yeah. Through failure, we typically have the greatest learning. Now, interesting is that we also analyze our failures much more than we analyze our successes. If you're in a big corporation, like at Intel, and you start a project, $10 million, 30 people, 12 months. And you finish spending $50 million, 100 people, and it takes you 2 years. You wouldn't believe how many management review committees you have on your back trying to analyze why you overspent, you over-resourced, you took longer than it should have taken. You analyze those. Same project. You spend 20 million, use 20 people, and it takes you 8 months. You get an award, maybe a little bit of cash bonus, but nobody goes back to look at why you underspent, better resourced, better planned on a time-wise. Nobody goes back and looks at that. They're just assuming you did a good job. But maybe you could have done it by spending 5 million, 10 people in 3 months. But nobody goes back and analyzes that because you're already better than what was originally estimated. So we typically, I'll say, over-evaluate our failures. We go back and really go down in depth and analyze our failures. That's why failure is so big for us. That's why it's culturally so big. Nobody wants to make a failure. In the US, they recognized in this scenario, it means experience. It means knowing what to do and what not to do. If you go to a VC and you've had 4 failures before, they're going to say, well, they're not going to do this anymore. They're not going to do that anymore. They're not going to run into that pitfall. They're not going to do that. They basically, their risk is lower because this person has done a couple of other failures. That's the way they see it. Now, our European culture is not that progressive yet. If you look at it, you'll find that even legally, we have different restrictions. So if you're in the UK and you have a company failure, you're banned from starting a company for 5 years. In Italy, that used to be 15 years. They changed that to 5 as well now. In Germany, you never lose your debts. So if you crash, your debts are still tallied somewhere, and as soon as you make a profit, you have to pay back. So our cultures do not readily accept failure. And that's something to look out for in Europe, to be careful about in Europe.
In Europe, they memorize longer debts. If you fail, you lose your trust.
Sorry.
I think that in Europe, that people memorize you longer when you lose your, when you fail, then you lose your trust.
Yes, very, very often. Your credibility, your integrity, you lose that all, yes. So, as I said, in the US, that can be seen for the VCs as actually something positive. In Europe, it would be very tragic. Okay. So failure without learning is a loss. So if we just fail and we don't learn from it, it's a loss. Failure with learning is a value. VCs want to see experience. So they see that as a value. The rest of our culture don't. They want to see that someone's not going to naively go down the same path that they've gone down before. So as students, how do we learn? How do we make failures without running into a disaster? Any idea?
Learn from others' experiences.
Learning from others? But how do you get the experience yourself?
I think starting soon enough does allow age to failure is not as fatal as, you know, if we do it in like 15 years later when we have families and stuff. So
Well,
now we can afford some failures.
you can afford failures a little bit after your studies, but if you do and exercise it during your studies, in your CV, it will never show up. Okay? So, and how do you do that in a safe environment? Safe environment meaning no one's going to really punish you. Okay? We exercise those skills independent from income, like you said, early on, without the risk of failure that brand marks us for the next years. We compete in business plan competitions. That's a platform to exercise entrepreneurial skills. When explaining this, when we were coming up with this and discussing with Berkeley and trying to explain it to Intel, we had to take the analogy, okay, what is a business plan competition? Because they thought, okay, we were investing, you know, millions over global. You have to try to explain to them why is this valuable. They say, well, you know, we're taking, if you're studying computer science, we're taking those computer scientists and taking them and bringing them into a programming lab so that they can exercise their skills. They you know, learn the theory, they go to a lab and they become proficient in programming. Business plan competition is the lab for the entrepreneurship education. It's an environment that gives you the opportunity to be an entrepreneur without having as high of risk. I mean, it depends on how far you really go into that. If you really do start your company, you really do start investing, you really do. But as in a business plan competition, you can go through all of the movements of being an entrepreneur without having that high of risk. Which is why we put a global business plan competition in place. We practice these skills while we're still studying, write business plans based on our ideas. We compete against others regionally, globally, and that actually helps you also thinking globally. You see what others and how others present. You see how they take different approaches. So it's an experience gaining exercise that, yes, it means work, but the experience you get out of that is incredible. So what is a business plan? We just said we do business plan competition. What's a business plan? Talk about this a little bit later. I'll show you one. Can you read that? One page, 3 paragraphs, 9 sentences, 165 words, 3 errors. Intel 1968. Today, $54+ billion revenue, 65% pre-tax profits. Okay, discipline of business plan writing has changed a little bit now these days as well. Okay. But that was the business plan that Andy Grove put in place to fund Intel, 1968. Three paragraphs. No financials, just the vision. Okay. We'll go into business plans later. Usually when I lecture this as a full plan, we actually go into the business plan generation, present, get feedback, video feedback, etc., mentoring, etc., which takes a lot longer than we have in these 2 days. Okay. Venture and growth capital. New venture funding stream. So when we start a company, we have that curve here. We start off with something worth $1, just to have a number, a model. And then we get first capital round, we get funding of $8. We start getting sales, we get another a round of $20, $40, $80. Okay, just as a model here to look at. How can we do that? How do we get multiple rounds of funding? How do we get funding at all? Why is a VC going to give us money? Because I've got a great idea? Well, maybe I get the $1 because of that. But how do I get the $8 and the $20 and the $40 and the $80?
When you have a proper business plan and market research and all that done, then you maybe
What's this worth? Huh? 10 euros, no. What's it worth? Come on, what's it worth? No. Paper. Probably less than a cent. But I can go to the store and I can get something for it, right? Why is that? Because they accept it. Yeah, but why do they accept it? Because they trust it. Well, no one trusts the euro right now, but that's a different discussion. Usually I do this with a, the lowest denomination. I didn't have a 5. It's trust. It's trust. This has no value. How do I build trust? To get from here to here to here to here and so on, we need to build a level of trust. How do we do that in a new venture? You're great people, high integrity, great vision, but can I trust you?
$2 from that $1. Like I build more value out of the investment.
How do you build more value out of the investment?
By selling product, by making prototypes, going into market, marketing.
Okay. I'll get into that in a more structured way. The why of multiple rounds is basically value over time. It's a step function. It's a function of the technology and product. So basically 3 vectors I'm looking at right now. Technology and product, the marketing, and the management. It means I need to articulate from round to round to round how I've moved up this curve, how I've increased the value of the company. So let's look at each of those vectors. So now we're looking at the technology value, okay? So over time, at the very beginning, we have a concept, then a feasibility or prototype, patent application, a working prototype, so it's actually doable, a manufacturing prototype, so not only doable but also manufacturable. We have the regulatory approvals if it's like a telecoms component, and we have a market introduction. So each of those steps, as I show to a VC, from one round to the next, shows that I'm moving up this ladder. I'm getting closer to the big company. And helps me articulate the value improvement that I need to have to move from one to the next to the next. And I do this with the market value. So at the very beginning, I have a market analysis, research, surveys, technical reports. I have a beta test of the product in the market and feedback. I've launched it into the market. I have satisfied customers, and I have a backlog. What's a backlog? I said ask questions if you don't understand something. Backlog. Is when you have more orders than you can service. So if you have a backlog of 3 months, it means if you would stop today, you could still If you would stop selling today, you could still run for 3 months, just producing and taking the product to the market. Very valuable for a VC because they see, oh, these guys have actually got to the market and are servicing the market. And there are customers that are willing to buy and pay. Okay. And the next vector, adding management value. Okay? So we have a CTO, we have a president, marketing vice president, a controller, etc. So we've gone up the human resource ladder. So we're complementing on the technology side, on the marketing side, and we also have now the right people in place to grow and scale this company. That's how we can articulate from one round to the next the additional value we're bringing. We can discuss each of these points with the VCs from one round to the next. Sure, you're going to have the discussion, well, is that value $4 or is it $8? But if you go through there, that's the way you articulate additional value. So if we put this into sync with our original curve that you all have in front of you, then here we're in concept definition, early validation, we're getting some market traction here. That's when we start to sell. Our scale is validated because we're turning this around, and here we're getting into a predictable scale. We overlay that now with these different investments, then you would look here in this area for a seed, here a Series A investment, here a Series B, Series N, so just moving on if you need that, and possibly an IPO at some point in time there. Everyone understands IPO? I think I said it before. Initial public offering. So this is when you go to the stock market and sell parts of your company to the stock market, to the investors, external investors. Now it's going to get a little bit more complicated here. Venture capital tends to clump by region, industry. It's important to encourage local investors. As I said, though, VC investment is a function of profit. So if they can make a profit in a certain country, then they will move there. Here's the data, and you will get this on PDF here. It's a little bit of an eye chart. But basically, this is Europe, and this is US, okay? Gives you an idea. GDPs are about the same. This is by different countries. And this is the patent applications comparison. You can actually read this when you print it. When a VC looks at a company, it will look at a number of criteria. A lot of the criteria is hard to describe because it's like chemistry as well. Their gut feel. So these are all irrational type things. But they do use kind of some rational aspects to try to scale where you are, what you are, where are you here. And this is not very legible here. Okay? So if we're looking at technology, they will look at stage of development. So here you're in the concept phase. You get a higher valuation if you already have a product. Look at patent status, nothing filed. Here you have a patent issued, higher valuation. Time to market is very long. Here it's short, higher valuation. Because you get to the return on investment quicker. In the market, have you demonstrated the need? No, not yet. Here, yes, higher valuation. The size is small, here it's large, higher valuation. Penetration, slow, here it's very rapid. Management team is novice, unexperienced, new, is a lower evaluation. Here you have attested people that have done this before, higher valuation. Financials, profit margins are low, here it's high. Capital required, high, is a lower valuation. Required low is a higher valuation. Okay? So sometimes what you might want to think about is when you go in there and looking for your financing is not to go with a $40 type approach. I need $40, but let's get this first round done. Let's get the first year done. Focus on the first year. And then move forwards from that. Altogether a better approach anyway. Okay? Return on investment high, time to liquidity short. So there are some of these where you can evaluate and take a look at these different companies and go through those and evaluate. Okay. Growth capital. How much time do we have here? Another 20 minutes? 15. Okay. Okay. I'll go through part of this. What I'd like to do then in the lunch break or after the lunch break, you all received a PDF with company descriptions. Okay? What I want to do after the lunch break is for you to evaluate those companies basically based on this table. And then identify someone in your team that will present the top 3 in order of top 3 evaluated companies. Okay? Only takes a couple of minutes for that to be presented. That's what we'll do after lunch, just so you know what we're planning there. I'll go into this growth capital because I'm not sure if we'll get through this then completely today, but we'll start moving here. So here the idea is 3 of you founded a company and you purchased 1 million shares of stock at a purchase price of a tenth of a cent. Okay? So that gives you 1 million shares. Each of you own 33% of the company, which turns into about $1,000 each for your investment. Then we go on and we hire a CEO, we create an option plan. We still have the 3 founders, but we've hired a CEO, given that CEO, actually had that CEO buy in 20%, okay, at a price of 1 cent per share. Okay. investment of $10,000. And we've put aside for future an option plan to be able to attract other new leading employees of another 20%. So now each of the founders owned only 20% of the stock. I owned 33% beforehand. So I'm giving up equity. But I also have a president that brought capital into the company. And now my company is worth, my part, the 20%, is worth $10,000. Okay, everybody follow that? Now I get a VC funding, finance purchase price of $1 per share, 5 million shares, a value of $1 per share. Now I only own 10% of the company as one of the founders, but that's worth $1 million. Okay? One of the issues that always comes up is that founders are very unwilling to give up equity against investment. But you can see here that you're actually getting a better deal. You don't have as much to say because you're only 10% of the company now as a founder, 10% of the voice. But your $1,000 turned into $1 million. So giving up equity has its pros and its cons. Very often founders don't want to give up equity at all, which hinders the growth. So if we go to the next, we get a Series B financing, okay, $2 a share, et cetera, et cetera. These two investors own 66%, okay? My 6.7% of the company is now worth, though, $2 million. Okay? This is a model how this works in those financing rounds. But you have to give up equity to get there. Okay? And we keep on going. We do an IPO, go to the stock market. I now have only 5.6% of the company, but that's worth $10 million. Now there could be limitations depending how you define when you can sell the stock, et cetera, et cetera. So it might be something more for the future, but on paper at that point in time, it's worth $10 million. So if we look at that, we kind of move up this chart like that. Okay? Think back. Each step we need to justify the value. But by being able to justify the value, we can articulate that to our VCs, but also to other finance people, that we are increasing the value of the company. Something interesting, though, along those same lines, we spoke about, power here. We spoke about the equity going, our percent, our voice in the company going down. This is kind of what it looks like. So Yeah.
Is it common that the VCs get 50% at the first series, or is it just a model?
Later, not today, tomorrow, I have a formula for you, what to expect on request. So pre-finance evaluation, post-finance evaluation, and what they would want in equity for that.
So that's like
But that's kind of, when you take the formula, you still need to negotiate, okay? And some will want more because they want a higher return just from the investment, and some will be happy if they can help you scale. They get the return out of the scale. So there's a after you calculate the formula, there's still a bandwidth between which you need to negotiate. Okay.
But actually, a founder can work with a formula, so he knows when he's going to.
You can take a look at your company, your investment, and then it comes out, in the example I have, something like 41% that they want. Okay, so you can figure that out ahead of time about what they would be expecting. Okay, and then you try to get them down to 30 or something. So.
And is it useful to buy shares back from the VCs after you got profit?
If they will let you, and you're making more profit, yeah, sure, why not?
But you have to write it down before we get the VCs.
Well, if it's from the VCs, yes. If it's on the stock market, by that time you just buy from the stock market. Okay. Many of the big companies that were very broadly spread, like Intel, to help the stock advance, buy stock back from the market. Waits until it gets a little bit lower, buys it, okay? And then there's less stock on the market and the stock goes up, and then, depending on it, it's very, very risky, depending on the value. But there's millions of stock they've bought back per quarter for a number of years. But yeah, I have an example on the calculation there. That'll be there tomorrow. Okay, so the control goes down here, and then as you get crossing here, you get a little bit more, but not in comparison to the revenue naturally. It's just to show that once you get your first, here you're totally free. You can do, and you don't have an advisory board or that officially guides you, etc. So, zone of freedom, zone of management. Okay. When you evaluate a deal from the companies, from your perspective, you're looking at the founders' needs, issues. What are they looking for? You have employees that are also interested in how the company moves forwards. You have corporate issues, the company as a corporate issues. Do we have enough capital? Can we operate freely? Do our investors own more than 50%? Things like that. Those are things to look at. If your investor A series is different from your investor B series, you can have issues there between those two if they're not really aligned strategically. The investor are looking for adequate return, looking for an opportunity for a home run. Know that terminology? Home run? Home run is baseball, American baseball. And a home run is when you hit the ball out of the park, basically. So, excel, super. You would probably call that a gazelle in Europe. A very fast, high-moving new venture. They're looking whether there are potentially fatal flaws, so logical flaws in the system, where you might excel and then okay. Timing requirements. Investors are looking for different returns. So for IT are looking for X times their investment in 5 years. Pharmaceutical are looking for that investment return in 20 years, because it's going to take them 10 years to get through FDA approval. Follow-on investment requirements. So in the business plan, even though you might be asking only for the $1, you should tell them, well, we're anticipating in 2 years' time we're going to have to create a new manufacturing facility to scale, and that's going to cost this much, and we're going to need R&D investment of this much to actually get there with the product, et cetera, et cetera. So they'd like to know that up front, just to know what they might need in the future. Portfolio and fund compatibility. There are VCs that are focused on IT, there are focused on pharmaceutical, et cetera. So a pharmaceutical VC, even though you might meet them, you know, talk about it to them, they're not going to invest. Okay? Even if, you know, meet someone on a plane or something and talk to them, they're, you know, you're just orthogonal in the whole thinking process. So focus on those VCs and angels that are focused in your area that your product is focused on. Okay. That's basically, I think, where we can cut here.